Hi, folks. I'm Sam Chandan, the Silverstein Chair and Dean of the Schack Institute of Real Estate. Thank you so much for joining us today for this edition of the Capital Markets Leadership Series. I'm joined by my colleague and friend, Dustin Jones, the Academic Director of the Schack Institute and specifically our graduate programs. Dustin joined us just a couple of months ago after spending 6 years at the helm of Cornell University's Baker program in real estate, and it has been a real blessing for us that Dustin has come down to New York City and become an invaluable part of our program. This series is sponsored by Arbor Realty Trust and by the Commercial Real Estate Finance Council. Every other week, roughly, we interview or sit down with and have a conversation with a CEO, chairman, or other leader in the real estate capital markets. It's a companion series to our REIT leadership series, which we host every Tuesday from 12:30 to 1:30 Eastern time, where on Tuesdays, we are joined by a different REIT CEO or chairman. And occasionally we have a little bit of overlap in our worlds, as we do today, as you'll hear about Tammy having taken on a very significant role at a very, very significant real estate investment trust. Replays of all of our programming, including both the Capital Markets series and the REIT series, are available on Schack's YouTube site. So that's youtube.com/NYU Schack. And I'll share that later on in the chat feature. As we're going through today's program, please do remember that you've got the chat function that I'm going to be keeping an eye on, but perhaps even better, use the Q&A feature. Drop your questions in there. We'll be keeping an eye on those. And if you, in particular, if you see a question you like and that you want to make sure that we ask Tammy, hit the upvote. It helps it to rise in the order of questions. You can also comment or elaborate on the questions that have been asked. So we want to make sure that there's a little bit of interactivity here. Please take advantage of that. And we have a special guest, Kirk. How are you? This is such a wonderful surprise. As everyone knows, we're all a family here, and I'm thrilled. It's not Angela Mora at all, but it's Kirk Sykes himself. Tammy, we can stop for a second. Introduce Kirk.
For a second. Hang on one. Well, first of all, thank you. A surprise guest from my very best friend and husband. I think that we need to, first of all, Kirk used to be the chair of the Real Estate Executive Council, so we will talk about that a little later. But Kirk, I think you're using a link that you're actually live in front of everyone.
Oh, okay. Well, that's good. I like to be live. I'm always live.
We probably want you to go in another one of those chats, because we're actually live.
Make him an attendee.
Oh, I'm so sorry, Angela.
Yeah,
no, not at all. This is a
right.
wonderful surprise.
This is like storming the stage at a conference.
I'm gonna use this to make a plug.
Since I have the mic, congratulations to Dustin for joining a great illustrious organization, and congratulations to Sam for getting Justin to join him. So I will now go away back into obscurity. Take care.
How many women have ever had that happen? So this is a first for all of us. All right. Thank you. See you later.
I'm gonna take a second to do a quick plug for Kirk. Take a look at the work that he and his team are doing. Some of the truly transformative placemaking work in Boston. I had a chance to interview Kirk a couple of months ago, fairly early in the pandemic, and that podcast is available on Apple. We talked about transformative placemaking and some of the projects that Kirk and his team are really pressing forward with. Tammy and I and Dustin will touch on the role of the Real Estate Executive Council in the industry, of which Kirk is the former chairman. But incidentally, Kirk also is the former chairman of the Federal Reserve Bank of Boston, and has done a tremendous amount of work in urban investment. When the Opportunity Zone program was just kicking off, Kirk was very gracious in coming down to New York, making the time to join our 52nd annual Capital Markets Conference to really give some perspective on the Opportunity Zone program from the perspective of someone who has a real legacy and history in investing in urban communities. Because of course, in the early stages of Opportunity Zones, we saw that rush to capital. We saw a lot of folks that very quickly had developed, or let's say had developed a very sudden interest in urban investment. But to hear from Kirk and get that perspective from someone who sort of has a history of engaging with the community really added a critical perspective. For this series, again, the Arbor Realty Trust and Cressy are the sponsors, and my thanks to Ivan Kaufman, Chairman and CEO of Arbor, Lisa Pendergast, the Executive Director and CEO of Cressy, for their generosity and support of these programs. Speakers that we have coming up include Craig Solomon, CEO of Square Mile, Lisa Pendergast herself, Executive Director of Cressy, will be talking to us about some of our legislative and policy priorities in Washington. We actually pushed that back till after the election. And I think that's going to allow us to really get Lisa's sense of whether we have a returning administration or a new administration, what the implications are for the real estate industry's priorities in DC, and Miriam Wheeler from Goldman Sachs. So we're really excited. And I have to say, one of the things that I'm particularly proud of, this series, 50% of our speakers have been women. And when we look at the roughly 35 or 40 speakers that we've had so far at SHAC since the pandemic began, we're at about 40% there. So I have a little bit of work to do, but we'll get there. The Tammy Jones, where do I begin? Tammy is the co-founder and CEO of Basis Investment Group. At last time I checked, you and your team have done about $4 billion in transaction activity since you founded the company. You are also the chair of the Real Estate Executive Council. And for folks for whom this may be relevant, I would really encourage you to learn more at REIC.org, REC.org. REIC is, and I think it's fair to say, we'll talk about this in a little bit, the preeminent industry association for Black and Hispanic executives in the real estate industry. And not only an important industry association, but I can tell you from my own experience as a member of REIC that it's also been a great family and a great source of support, both personally and professionally throughout the pandemic. You are also a board member of Mack-Cali. And congratulations. I saw the press release yesterday that you've just been appointed to the board of Crown Castle as well. And for those of us who are old timers in real estate and may think of real estate as being the core property types, we're going to want to hear a little bit more from you about how Crown Castle is breaking that mold. You are a board member of the SHAC Institute. You and Kirk have both been extraordinarily supportive of your alma mater, Cornell University. And I have to say that you have also been a mentor to peers like myself and to an entire generation of young people, especially people of color that are looking to break into and find a path for themselves in the real estate industry. So Tammy, before we even dig in, just thank you for all of the incredible work you do. It's inspiring.
Well, first of all, thank you to Sam and Dustin. It's so amazing to be able to have what I think is going to be a fireside chat and a conversation with two of my favorite people. I had the opportunity to work very closely with Dustin at Cornell. He, ran the Baker program, and we did amazing things together. And now he is with Sam, my other favorite person. And so, hopefully we will be able to touch on some things that the audience, is interested in. I want to thank SHAC and also the sponsors, because these types of programs are important, so we can talk about the market and hopefully go into a few different directions. And as far as Kirk is concerned, as a SHAC advisory committee member, we will forgive him, but I also think it shows us why office is important. Because can you imagine if someone busted in your office room, you could actually have stopped them. So I think that was one of the, we showed the audience some of the flaws of the Zoom technology. So I just wanted to say that was
if it were anyone else, it would have been a flaw. But because it was Kirk,
the Zoom bomb.
But again, it just shows that technology is not exactly perfect. That's all I'm saying.
So kick us off. Tell us about Basis Investment Group and how you founded the company.
Yeah, so I founded the company, ironically, in the great financial crisis. So as you can see, I'm a person that believes that in challenge and in adversity, there's opportunity. And I saw many people in different cycles, venture out and actually create large platforms and create wealth. And so for me, I've always had that entrepreneurial spirit since I was high, and I've always thought about wanting to own my own company. And then I will honestly tell you, as an African American woman and someone who, didn't necessarily see a path to the C-suite for myself in some of these large platforms, it was a great impetus for me to be the change that I wanted to see. And so founding Basis, my vision was to create this diversified investment management platform that could invest and lend across the capital stack in the middle market where I saw a lot of value. And we've been in business for 11 years. I can't believe it. It just seems like time has really flown. And we've been able to every year expand into a different strategy across the capital stack. And so now we're doing debt and equity, which I'm super excited about as a diversified platform with a focus in the middle market. And I believe that we're positioned well to withstand cycles because we can invest in targeted positions for our investors. We basically deploy capital for some of the largest public pension plans, sovereigns, family offices across the country. And we are very focused in ensuring that we're finding the right positions and right strategies to invest in, which we'll talk about.
How did you develop the relationships? When you're working with big family offices, pension funds, that doesn't just happen.
Right. Well, I think, one of the biggest challenges that I think we face as, minorities in real estate, as well as anyone, that is trying to launch a platform is access to capital. And so when I led the platform at CW Capital, before I founded Basis, I had a number of relationships with large family offices, particularly in New York City. And I went out and I wrote a business plan. As you all recall, the market was at a standstill. And I have a type A personality. And I decided, you know what, I'm going to write a business plan, had a little bit of money saved. If there was a time that I was going to actually go out on my own, it was then. And after I got over my own personal fear, because I know we all have that, right? I decided to go out and just talk to my relationships where I knew folks had capital. And I got down to number 7, which means I faced a lot of no's, right? And so that's another lesson for anyone listening is be prepared for rejection. I got down to number 7. It was JEMB Realty, and they're my partner today. And what that helped me do was to have not only a GP sponsor that also provided infrastructure and all the things that you need when you kind of roll out of a large institution, but it also gave me my first 100 million of LP capital to invest at a time where, I had, to look at a market that was really distressed. And we wound up actually buying distressed bonds as opposed to distressed debt from banks initially, because as you know, it wasn't like droves of distressed debt came out as quickly as we all thought. And so I think that, for me, there were a number of lessons learned in making sure that you pick the right partner, making sure that you know what you need, because I always say to people that I advise on going into becoming entrepreneurs, that 100% of zero is zero. So sometimes you have to bring in partners strategically to facilitate growth. And so I'm happy to report that now we have, I think we're up to 17 different investors. So the plan was to create an investment management platform leveraging off of the initial investor. And now we're diversified because as real estate investors, we know that diversification in your portfolio can make a lot of sense, whether it's geography, whether it's across the capital stack. But I also believe that diversification or having, diversity in your investors is also good because you never know which investor may be facing a particular cycle or hurdle where they need to pull back. And so, it was very important to strengthen our balance sheet and to strengthen our investor base that we were able to do that. And it took time. I mean, we've been in existence for 11 years, so it doesn't happen overnight.
So you've done both debt and equity now. You're focused on the middle market. We do have students that tune into these from from SHAC, but also from real estate programs around the country. Just explain a little bit what you mean by middle market.
So for me, I used to say that the middle market, most people say secondary markets, and I don't like to say that because I don't necessarily think that these markets are secondary anymore. I think about growth markets. I think about places where at least pre-COVID, and we can talk about even post-COVID, there is population growth, employment growth, where you have various sectors that you think are the growth sectors, whether it's tech, healthcare, financial. And so we focus on markets that kind of meet that criteria at the high level. And they're markets like, I'll say Charlotte, Salt Lake City, we've invested in Baltimore, we've invested in areas in and around parts of Texas, Dallas and Houston, historically in our portfolio. We're looking for, and then middle market also is by size, because when people talk about that, it's for us, our check sizes are 5 to, we say 75 million, which is, probably on the higher side. But I think the takeaway is that there are the gateway 24-hour urban cores. And that's an investment approach and strategy. And if we invest in New York, we may invest in some of the burbs. We may not be in Manhattan proper. And someone would argue that that's not the middle market, but that's okay. That, again, middle market is the definition that you want it to mean. But I do think that it's places where we're saying there's a different demand driver other than just being an urban core, gateway city, coastal market. And so for us, that is what the middle market means. And we think there's a tremendous amount of value. In addition, the middle market is about 7.5 trillion, or half of the $15 trillion real estate market. And the middle market is made of a lot of, regional players and some, smaller real estate investment companies. And a lot of those owners are currently the baby boomers, and they're beginning to age out. And the demographics tell us that 10,000 people are turning 65 every day for the next 10 years. And so we believe, our thesis was, and it's beginning to really play out, that there will be situational distress, not necessarily the kind of distress that's coming from an exogenous force like the pandemic, but just transfer of ownership, second generations not wanting to own the properties in the middle market. And where we believe we have a competitive advantage is that the middle market is very much about relationships, and you can't just show up there and expect to be competitive. And so I see a lot of, different platforms starting to focus on the middle market because everyone's looking for yield. And we'll talk a bit about that. And you're finding more yield in the middle market, and the middle market's actually holding up probably better than the gateway markets, even in this pandemic, because of the fact that the density, is very, very different.
So question for you in that regard, so much of the, our attention being located in New York, for other folks, reading the press, a lot of our attention in the general press is on what's happening with the biggest properties, the most high profile investors and owners. But when we're thinking about those middle markets, in the early stages of the pandemic, and then again, sort of, now 7 to 8 months later, how has access to capital, the availability of capital changed?
So I think, in the beginning of the pandemic, I mean, all of us were just triaging, right? I mean, we were all worried. I think people were just afraid that, is this going to be as bad as the GFC? Are markets just going to completely stop? And I think that there was just a lot of uncertainty, and the same type of uncertainty. And having lived through, like all of us have, and actually launching a platform in the GFC, I think some of that experience really helps to inform us on how to think about this. So I think the capital markets, as you know, in March, I mean, spreads gapped out. I mean, there were margin calls, lenders were beginning to start. There was a period, in late March and early April, where I was getting calls from a number of other, non-bank alternative lenders for, to see if we were interested in buying debt. And it was just a period of panic. I think that we've normalized a bit since then. And I'll tell you that the capital flows are so important, and they're holding up, what transactions activity exists. And one of the things that I should have mentioned when we talked about basis is we are also a seller servicer. So we're involved in GSE lending. And I want to just talk about the importance of having, the Freddie and Fannie Mae organizations to hold up the housing industry. I mean, we have an affordability crisis in America, and we need housing to continue to thrive. And so I would start by saying that the GSEs were the liquidity providers, and they did the same thing in the great financial crisis. That is what they're built for, is to continue to lend in the face of adversity. And so I was so thankful that Basis has a seller servicer license with Freddie Mac because, again, that's the whole diversification play. When one part of the business might be, staggering a little bit, if you have another part of the business that's thriving, that's always a great thing. And so the GSEs were continuing to lend. Yes, there were a couple of pullbacks because of trying to figure out whether we're going to have debt service reserves and forbearances and some other things. But they by and large, continue to lend through even the worst parts of the pandemic. The CMBS market was just shut down. I mean, spreads were wide as all get out. And I think that just the uncertainty of how do you underwrite these stable deals when you don't know where the least occupancy is versus collections and what's the physical occupancy. How does that all, get incorporated into what our normal underwriting was? And people were not ready to just write down things or sell things. I would say the bridge market, even for alternative lenders, was a little skittish because many of us who are lending in the bridge market have lines from banks. And so if the banks are pulling back, then certainly we, as anyone who has lines from some of the major banks to facilitate the bridge business, we're pulling back. Today, I see, CMBS is beginning to come back. Again, volume is down, but certainly there are deals being done, which I think is super important too, because that's more of the stable stuff. In the bridge market, things are starting to come back. And I can tell you what Basis has done. I mean, we've been, very selective, but we have, between our agency business and our other businesses, we've probably put out about 350 million since the pandemic. And a lot of it has been, obviously agency is multifamily, but even on our fund side, we've done a lot of multifamily deals, really interesting stuff, and one office deal. So again, I think that you have to be opportunistic. And I do believe that it's early days for, like, as I mentioned before, droves of distressed debt. But I do think that there are places where there's recapitalizations being done. It's not distress because people are ready to say, this property is 20% below what I paid for it, but it's distress where people may need liquidity. And that to me is situational distress. And so we are all over that.
Yeah. So when you talk about your role in the multifamily sector, the role of the agencies in continuing to provide liquidity, but on the other hand, also some of the CMBS deals coming back, are we seeing the composition of deals, whether it be at the loan level or the new CMBS issuance, does it match I think the market's intuition today that retail and hospitality are risky and are characterized by greater degree of uncertainty, but that apartment and industrial are safer bets. Office may be somewhere in the middle as the debate rages on about how often we'll be going back in and how we'll use office space. Is that reflected in what's where we're starting to see improvements in activity?
Yeah, I think so. I think everyone is concerned about, let's just start, like we talked about the hotel sector. And I can tell you that, across the nation, many hotels, well, in March, hotels were closed. So there wasn't a discussion about what to do because they were closed. And it's clearly you're not going to be trying to lend on something that's not open or securitize it or whatever it is, right? Today, a lot of the hotels are open. The issue is occupancy, right? So, in our portfolio, thankfully, we don't have too many hotels. In our direct portfolio, we have 3. And I was just saying, this is just a small cross section. Right before the call, I checked, obviously all of them are open, as I mentioned. And occupancy is anywhere from 25 to 60%. And the 60s has a special situation. So if we look across the hotel sector, and you guys heard from Leslie, occupancies are way down. So obviously, no one has a crystal ball. No one knows exactly how to underwrite that cash flow and how to underwrite when there will be a recovery. So the hospitality sector, is really there's going to be some time before, in my opinion, before that comes back. And then let's talk about retail. So I view retail as it's not just one big thing, right? Let's break it down. Drug and grocery anchored centers, community centers actually fared pretty well. And that, honestly, there are a lot of those centers in the middle market, and we focused, our thesis was drug and grocery anchored centers, staying away from big box, staying away from malls, pre the pandemic. And so I can tell you that the vast majority of our retail is this property type. And it got hit. Like in March, collections were about in the 60, like I say, mid 60s, which barely covers debt service or may not cover debt service with some small shortfall that at the time many sponsors that have cash in the deals weren't willing to just walk away from their properties. So that collections level has now that seems to be the trough, as I'll call it. It seems to have actually improved. And now our, not just our portfolio, but across the country, it's probably in the mid 80s, maybe, like I would say low to mid 80s in terms of collections at those centers, because a number of them have grocery store anchors or drugstore anchors, and they also have the smaller, tenants that over the summer were open. And so we'll see if it goes back down. I don't know if that will be the case, but I will tell you that property type, that part of retail, I just want to make sure that everyone understands that actually did pretty well. Malls obviously have issues. Restaurants, in major cities, obviously did pretty well over the summer if they had space to open up outdoors. And so I really think that retail requires a level of analysis where you're really trying to discern, between what it is and what are the demand generators and what are the risk factors facing it. And that's what we spend a lot of time doing. But that said, I think that the sector itself has a taint. And I think that unless you approach it the way I'm suggesting, which is to sort of break down the various aspects of retail, then you probably would stay away from it. But healthcare, I'm not healthcare, fitness centers, car dealerships, car sales are up in the pandemic, right? So car dealerships are doing really well. So if you have a retail that facility that has a car dealership in, on the property, then maybe you have a different view. So I guess I'm just encouraging people to think through retail more thoughtfully, and then also adaptive reuse of retail. What can we do with it? There's so much creativity going on. I mean, and then if we move to office, just quickly, the Zoom environment basically has transformed office, at least now, and during the pandemic, the way Amazon transformed retail. We've heard people say that before. And I do think that we have accelerated any kind of, virtual and remote, either officing, working, learning by a decade at least. None of us thought that this was going to happen so quickly. And so my personal opinion is that I believe in New York. I'm a New York City girl. I mentioned, I think that I was born in Queens at some point, and maybe I didn't. And so I believe I think New York will always come back, but I do think that it's going to take time. And I do think that there's going to be a hybrid model across, all of the sectors. And I do think that in many cases, maybe, we're over office, like we were over retailed. We were over retailed compared to other countries. We have way more malls. And so maybe there will be some adaptive reuse and changes to the use and how we're using office and the physical layouts of office. I do think that we're in for a transformation, hopefully innovation, because I think that when we think about change, I want us to think about innovation. The office portfolio, initially, I think on the leased front, we're pretty good because some of us have long-term leases in our portfolios. But on the physical occupancy front, particularly in New York, it's 20%, 30%, unless, this is an interesting thing, and my thinking has changed, and it would be interesting to hear what you guys think of this. The office buildings, even in Manhattan, that have smaller tenants, like the eye doctors, the dentists, are actually doing really well. They're, when I say really well, relative to the larger credit tenants that we would think about. And so it's an interesting thing as we process what is resilient in different types of stress. I think we're learning a lot.
You mentioned fitness centers, Dustin, anecdotal, you live across the street from your and my Equinox. Have people been going back? What's it like?
Interesting. Right now, Equinox has set up like an outdoor gym. They've got like a pop-up outdoor gym that they put on this lot here across the street from Hudson Yards that is basically a large tent. I think it's like Equinox in the Wild, I think is how they branded it. And it seems to be getting a lot of people going there because people are concerned about being indoors at the gym. Yep. And so I think it'll be interesting to see what happens over the winter when it starts getting really cold to be outside in the gym. But I believe that there are a number of other pop-up types of fitness facilities that are taking advantage of this situation or dealing with it.
Yeah.
Tammy, there's been a lot of focus on some high-profile articles that have appeared in the press over the last couple of weeks. One of them focused on the specific challenges to New York City, given our fiscal crisis, the undermining of our core agglomeration. And I'll preface this, of course, by saying that, like Dustin and I are in New York City, and we believe the city will always bounce back as it has before. That's not to say it doesn't face some real challenges, though. There have been articles also that have gotten a lot of attention, focusing on specific concerns related to CMBS, the potential for the rise in distress with some significant lag on the pandemic itself. How is it possible for us to say at this point how bad things get in terms of the performance of the debt?
I think it's uncertain. I actually think that there are factors that we don't know. I mean, if we're able to have a recovery because of a vaccine, or because something happens that allows us, or some other cocktail that helps us to get the pandemic under control, you may not have as much distress as we think. I do think that it's going to depend on banks and their, the regulator. Like, if banks can, just like we did in the great financial crisis, let's learn from that, ladies and gentlemen. We did extend and pretend for years, right? We're just in, what is it, 200 days, right? So there's some ramp for us to not capitulate and say, okay, done. We just need to mark all these things down. And so it's going to really, I think the banks are going to be drivers to watch. I think that a lot of what's been done over the last decade has been very conservative compared to what facilitated and precipitated the great financial crisis. And so I do think that there's a little bit more cushion. And so I think that buyers and sellers haven't agreed that we're in a distressed market yet. And it really takes that, where landlords are not forced to sign leases that are below market. There isn't a lot of activity. So we can't even tell you people say, well, rents in Manhattan are down by 15% or whatever the number is, 20%. Well, how do you know when there's not that many leases being signed? So I do think that it's going to take, it's early days. We're going to have to watch some of the signals. We're going to see who are the holders of the debt. Are you going to have, again, I go back to my situational distress. Are there liquidity events that are happening where people need and are forced to sell? I think distress initially is going to come out of being forced. Your hand is being forced to sell. And I think that there are many of us that are well capitalized, that have cushion, that can ride it out a little bit longer. And we saw that example in the great financial crisis.
One of the things I worry about, I was interviewing the heads of the National Affordable Housing Trust a couple of days ago, and some of her colleagues, and they were describing how they just raised $1 billion fund that is focused on preserving the naturally occurring affordable housing stock, that during periods of distress like this, to the extent that there is, even in multifamily, there is some impact, that with a well-capitalized industry, it's hard to put a number on it, but we've got capital on the sidelines, there's some dry powder there, that if this downturn looks like some previous ones, some folks will come in, they'll acquire that naturally occurring affordable housing stock, and they'll reposition it to be something that looks a little bit more luxury. But the supply of affordable housing, and this comes back to one of your earlier points about affordability challenges in the market right now, being exacerbated by the crisis. Is this something that we should be concerned about?
I think we should be concerned about it. And I also think that we're going to have to figure out ways to maybe reposition some of the luxury stuff that may not make it, right, in depending on where that particular asset is, into thinking about affordability. And then we need to think about, as we're developing new properties, and development is happening. I think some of the interesting opportunities are finding deals where they're going to deliver in 2.5 years, right? Where you're hopeful that we're going to be past this. So there is some development going on, and a lot of that development, I'm happy to see that does have a affordability component to it. So, but I do, I don't know that I have the answer to how bad it's going to be, but I certainly think that we were already in a crisis, as I mentioned, and so this is definitely not going to help, and we're going to need, not private and public sector to examine this problem and try to come up with partnerships to try to really mitigate some of what could happen.
Yeah, folks, I'm gonna turn it over to Dustin in just a couple of minutes so that he can bring the Q&A to the table. So just as a reminder, we do have the Q&A feature. Please drop questions for Tammy in there. Her sort of experience and direct exposure to the real estate market, whether it's again debt or equity or any of the different property types, is tremendous. So don't hesitate. Tammy, I want to shift gears though for a minute and talk about the Real Estate Executive Council. And again, it's folks who've tuned in. You've met 3 members so far, and Kirk as well. But it's, I know for me, it's played just a really important role, particularly during the crisis, having that connection to a community. Tell us about the role of the council and what your agenda is.
Yeah, so thank you. So Real Estate Executive Council, as Sam described, is a professional trade organization for African American and Latino executives in commercial real estate, and we're a national organization. And I think what Sam said well is we're also a community for each other. And I have to tell you that one of the things that the pandemic has taught me, and as the first female chair of Real Estate Executive Council, is that we have this agenda, and we've had the agenda to try to promote advancement and opportunities for African Americans and Latinos in real estate from early stage pipeline through the boardroom. We've had that agenda for the last 15, plus years. But what I think we all realize, I think, and hopefully, it's everyone, not just ethnic minorities, is one single thing, that we're in this together and we need each other to affect real structural and systemic change. And so Real Estate Executive Council has been focused on partnering with majority corporations and other trade organizations to try to advance a 5-point agenda, which, and I'll just go through it really quickly, because I think hopefully if people are looking for diversity and inclusion ideas, they can see themselves in some of these points. But the first thing is the development of a diversity ecosystem, which again is firing at all cylinders, focusing on early stage pipeline, middle management, senior leadership and C-suite, as well as boards, making sure that you as a company or as an organization are focusing on an ecosystem, not just doing what the easy thing is, which is to go get interns. Number 2 is to recognize that you need a diversity business plan. Ask yourself, what business or initiative would you launch without a plan, without a real plan that has concrete strategies, performance metrics, and or compensation tied to those outcomes? Just ask yourself that. Number 3 is providing access to capital and also access to credit, because our country is built on the backs of small businesses and entrepreneurs, and access to capital and credit is particularly hard for women and minorities. And so that's an initiative that we're very focused on. Number 4 is minority spend. Who are you doing business with? Are you doing business with women and minorities? And if you're not, why? And try to be very intentional about that. And number 5 is what we're doing here with SHAC and with the sponsors, is partnership, is making sure that we're in this together. Reese as an organization cannot, get all of those things accomplished without the help of all of you. And that's to me is the best thing about the real estate industry, is we do partnership well. We do partnership with deals. And so when we're faced with change, and the final thing I'll say is Reese is focused on the wealth gap, right? And so I want people to not just focus on hiring, because that's something that seems to be the 92.5% of the conversations about hiring, but focus on entrepreneurship and wealth creation. Because based on the Fed report, as my husband was the former chair of the Federal Reserve Bank of Boston, so he's involved in this, the average net worth of a Caucasian family is 171,000, and the average net worth of a Black family is 17,000. And in certain places, it's as low that, as $8 for an African-American family in terms of net worth. And so real estate has this amazing opportunity, because the difference in those balance sheets is real estate. And so how can we change that? Well, let's change our thinking. Let's think more about wealth creation and hiring, not just one.
So I have one more question for you before Dustin takes over with the Q&A. And folks, please do drop your questions in there. Dustin, you, me, along with Margaret Anadou, Jim Simmons, Craig Robinson, One Payne, Several members of our faculty, Gerard Delane, joined us. We hosted, I think, a really important event earlier this year in the early months of the pandemic called the Black Experience in Real Estate, and it coincided with that the peak in outpouring of visible frustration around a lot of what we're seeing happening in the country, and we're committed to making sure. And I think it was maybe Margaret who made the point: this can't be a moment; it has to be a movement. It's been something that has been a focus for us in terms of recruitment, pipeline development at Shack for a long time, and I'm really excited that a group of us are reprising that discussion, at our 53rd annual Capital Markets Conference in just a couple of weeks' time, so that again, the salient points are things that we can bring to the table with a large majority audience as well. Was it coincidence, in your view, that the pandemic, the affordability challenge, the loss in jobs, the disproportionate impact of the pandemic and job losses on communities of color, coincided with this surge in outpouring of expression earlier this year?
Sorry, I was hearing myself echo. No, it's not a coincidence. I mean, I think it just shined a light on what most African Americans already knew was happening. I mean, we have had healthcare disparity issues and concerns pre-pandemic. I mean, that's there are studies that have been done that show that that exists. We know, based on the wealth gap information, that empirically shows you that that just doesn't happen, right? I mean, the wealth gap has happened over a period of many, many years. From, I can go way back 400 years ago, or I can even just go to the GI Bill that created the middle class. I can, talk about redlining and just say that when you have the ability to buy assets, we all know this, you can borrow against them. You can send your children to college, you can buy businesses, and that's how generational wealth is created. So that's not made up. That is empirically proven and is a fact. And I would just say, think about the great financial crisis. The, minority communities were hit so hard, whereas other communities thrived in valuation. Some of those communities were just catching up at the pandemic and may not have even recovered fully. And so those things are real. And I guess for me, I've finally, and I've said this to both you, Sam, and to Dustin, that I do sense a shift, and I'm really hopeful about that. But I do think it's incumbent upon us to use our platforms to talk about it, whether you're a ethnic minority or not. If you're an affiliate and you believe it, we just have to keep talking about these issues and coming up with strategies to create action and take action, which is why I mentioned our 5 points at Reese. Hopefully someone will see something in themselves or in their power. If you're a bank, maybe you can provide credit. If you are a big LP, back some GPs that are, minority, African-American, Latino, and other ethnic minorities that would need the backing of an LP. And I do think that with the focus on ESG, which is certainly started in Europe, probably more heavily, the public sector, public companies, as you mentioned, I'm an independent director on 2 public boards. ESG is a real focus. ESG is getting ratings. ESG funds are outraising any other funds. And the S, environmental, social, and governance, the S, social, is really what we're talking about with respect to racial equality and equality across all that we do, and making sure that you're figuring out how to incorporate that into your investment process. And so I do think that private companies need to catch up with that, and there's so many things to do. So I don't think it's a coincidence. I think that the pandemic, I always call it the trifecta, where African American communities economically, we lost more jobs, and because we were on the front lines with being some of the the workers in the grocery stores, by way of example, and some even in the healthcare, we have the healthcare disparity, which we talked about, and then we also had what were the tragic murders all happening in the community, which was so overwhelming. And you can imagine how overwhelming it is to an African American person And it was just comforting to me to see that it was also overwhelming to many of our friends and affiliates.
Dustin?
Tammy, we've got a number of questions here, but one of them has risen to the top and has quite a few votes from others. You've shared the 5 principles that guide BASIS. But this question comes from one of our viewers, Jonathan, who's a white male, a mid-level professional who's committed to promoting equality, diversity, and inclusion, and is asking how they can be an advocate for these ideas of diversity and inclusion within the organization and promote this internally when they're not the one calling the shots, not the one that's the boss. So how do they be an advocate at the mid-level?
That's a great question. So I think that is one of trying to find sponsorship and mentorship. Even if you're not the person that can drive change, you have to be comfortable enough to use your voice. And if you have really good ideas, does your company have a diversity committee, an inclusion committee? That's the first thing. If they don't have it, maybe you're supposed to be the one that suggests it. Depending on the organization, part of it is the culture of the organization. And I always believe that, unfortunately, Jonathan, change does come from the top and the tone is set at the top. And that's why I am so passionate about making sure that there is diversity in the boardrooms that can receive those types of comments, and then diversity in the C-suite. But, when you're in middle management, you have a voice. And I believe that because of social media, because of technology, there are ways to promote what you're saying. You can write a piece, you can publish a piece and talk about what your issues are. So I think that what's really great and promising about middle management today versus when I was in middle management is that there's so many ways to make your voice known. Try to get other people that are like-minded within your organization to join you if you feel like you have really good ideas. If you're making a proposal, we don't want you to do something that, gets you in trouble with senior management. Don't say Tammy said for me to do this, but I am saying that there are ways to professionally, put together a proposal. And then the final thing I tell my mentees is you have to be your authentic self. And if you can't express who you are, then you have to question whether you're at the right place.
Thanks. One of our other viewers, Nathaniel, had a question that's probably implicit in everything you've already been sharing this afternoon, but what principles or professional characteristics have contributed to your success in real estate as an African-American woman?
That's a great question. The one that comes to my mind, because I'm a visual person, is grit. Being able to just have that stay power, even when things were not necessarily happening as easily for me, or when doors were not opening and there were so many challenges. I think grit. I think, integrity. I try to always, come from a platform of integrity. I think, being hardworking and committed. Those are some of the things that come to my mind. And then also being, real estate is a very creative, at least from my perspective, industry. And so being nimble and creative and trying to think outside the box when you're creating a company and a platform and you want to remain competitive, you have to always, think about how to navigate and get ahead of your competitors, right? I mean, so those are some of the principles that I think I would say come to my mind.
In terms of academics, what would one study? What did you study? They want to know if you have a background in finance because you're so well.
That to me, I love that question because you can study anything. We will train you. That's number one. I think that a liberal arts education is just as important, particularly undergrad, for critical thinking. I'm one of those believers, as a finance degree is. I think they're both great. I think finance is awesome as well. But I will tell you that when we look at hiring college level folks, we're looking at, a person, male or female, that we believe we can train based on things that they've done to demonstrate that they have commitment, that they have grit, all the things I just talked about. So I studied economics at Cornell, and I had no clue what I wanted to do. I fell into real estate because I went into a general training program at an insurance company, Equitable, many years ago. So I think that real estate, I just love the fact that it's so rich in so many careers. I mean, we have finance, we have.
Or you're visual, so you want something physical to see.
Yes, that's right. So what I
not just a stock or a derivative. There's a building.
There's a building. It's tangible. And I always say that was one of the main things that attracted me to real estate. But I will say there's so many careers in real estate that can use a number of different disciplines. So it's never too late. Like if you majored in psychology undergrad, we have a couple of those that work at Basis, which is great because they can help us analyze people. But I think good writing skills, being able to be creative, will teach you the numbers. And not every field in real estate is focused so much on numbers, right? And and then I went on to get my MBA, as you guys know, and really honed in on, some things that the economics degree didn't really help me with. But I do think that it's really about getting into the industry, getting the opportunities, and trying. If you major in finance, that's certainly helpful, but I don't think it means game over if you haven't.
We've got a question about going back to distressed debt. How can non-institutional investors find distressed opportunities in this downturn? Should they partner with local GPs in non-gateway cities? How do they build those relationships?
Well, I think with technology and crowdfunding and being able to access deals in a different way using technology is going to help what I would call a non-qualified investor. I do think that partnership is good for anything you don't know, right? I mean, don't just run out there and buy distressed debt. That may not work out well for you. So, I think that if you can get into partnerships where you're learning based on being a minority partner, even if it's a small amount, that's going to be helpful and will inform how you may make your next investment decisions as you move forward. So I do think that there will be opportunities. So I think, both through, technology, which there are even some private REITs that are coming out that are using distribution facilities. So there are opportunities, I think, that are opening up as a result of technology to allow for greater investment. But, finding the right partners and making sure that you underwrite, or at least understand their track record if you're going to be a person that's not going to have any control, is super important. Don't underwrite the deal, underwrite the manager.
Before I hand it back to Sam, remind our group what BASIS stands for, because I remember one time you telling me what BASIS, like almost like an acronym.
He always makes me say this. So BASIS is foundation, so that's easy. BASIS is a real estate term, right? What's your basis? And everyone's like, oh my God, how did you even have that name? But for me, BASIS means Black American System.
That's awesome.
And there you have it.
One last question for you then. I mean, as you pointed out, you founded Basis in the middle of the financial crisis, and nothing about the 11 years that have followed have been predictable or normal. Certainly for me, and I think for many of us, the most unusual 11 years that we could have possibly anticipated. Where is Basis 3 or 4 years from now?
So we're going to continue to expand our equity business, which is we focused a lot more on the debt side. And so we're creating this diversified platform. And again, the whole point is to be able to have Basis be what I think right now we are one of the only African-American owned diversified commercial real estate platforms. So, we would love to have, I'm not going to say what, but increase our AUM and then focus on both debt and equity. So that way, we can truly withstand cycles because we can invest across the capital stack and use that, that power to invest in both of those different positions.
Tammy, you are one of the smartest people in real estate, one of the most inspiring people that I ever have the chance to talk to, and also one of the busiest. And so I think Dustin and I and everyone at NYU truly appreciate your carving an hour out of the day. And congratulations again on the independent board appointment at Crown Castle. That's a really big deal.
Well, for you guys, anything, and for the NYU world and team.
As well as the Cornell Industry Leader Award.
That's right.
That's right.
That's going to make me blush. But listen,
recognize your alma mater.
This was a great conversation, and have a great afternoon, everyone.
Thanks. So, folks, remember, 2 weeks from now, we'll be joined by Craig Solomon from Square Mile, then Lisa Pendergast, Miriam Wheeler, Chris Lee from KKR will also be joining us. So really great lineup for the Capital Markets series, as well as the REIT series. You can find replays of all of these at Shack's YouTube site, youtube.com/NYU Shack. Have a wonderful day, and we'll see you again soon.